Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories behind those dusty corporate reports and expose the truth. Today, we're diving into a report that might seem a bit dry at first glance, but trust me, there is more going on here than meets the eye, especially when it comes to how our money works behind the scenes. We're looking at a current report from the Federal Home Loan Bank of Pittsburgh, or FHLBank as we'll call it now. This isn't your typical company filing like you'd see from Apple or Google. The FHLBank is a bit different. It is a federally chartered institution, meaning it is set up by the government to help housing finance across the country. Think of it as a bank for banks, especially those focused on mortgages and home lending. The report we're looking at is dated the 16th of January 2026, and what is interesting is that this filing is mainly about financial obligations. Specifically, it is about the money the FHLBank borrows from the public by selling debt, which they call consolidated obligations. These are basically loans that the public gives to the FHL banks. This is a Form 8K, which is used for reporting big events that shareholders should know about. In this case, the big event seems to be the creation of a direct financial obligation or an obligation under an off-balance sheet arrangement. Let's break down what that actually means in simpler terms. So, the FHL Bank gets most of its money by selling these debt securities, these consolidated obligations, out in the market. These aren't just promises from one single bank. They are actually the joint and several obligations of all 11 federal home loan banks. Imagine if 11 friends all promise to pay back a loan together. If one friend can't pay, the others have to cover it. That is kind of how this works. These FHL banks are watched closely by the Federal Housing Finance Agency, and this agency has the power to make any of the FHL banks step up and pay back a loan, even if it wasn't their primary responsibility at first. The money raised from selling these bonds and notes goes to the public through something called the Office of Finance using securities dealers. And here is a crucial point. These consolidated obligations are only backed by the financial strength of these 11 FHL banks. They are not guaranteed by the US government. That is an important detail to remember. Now, the filing mentions something called Schedule A. This schedule lists all the consolidated obligation bonds and discount notes that the FHL banks are committed to issue, where the FHL Bank of Pittsburgh is the main one responsible for paying it back. It excludes short term notes that are just part of their everyday business, and also includes any older debts where the FHL Bank of Pittsburgh has taken over the main repayment duty from another bank. The FHL Bank says they can change how they report this information whenever they want, but they want people to keep a few things in mind when looking at this schedule first. Even though issuing these debt securities is a big deal for them, they haven't specifically said if any single one of these financial deals is particularly important or material on its own. That is a bit of a careful phrasing, isn't it? Second, Schedule A doesn't talk about any other financial tools they might use, like interest rate swap agreements. These are complex financial products that banks sometimes use to manage risk or to make their debts more attractive. They might be connected to these loans, but they're not listed here. Third, and this is a big one for understanding the overall picture, Schedule A won't let you easily see the total amount of debt they have overall. Why? Because it leaves out those short-term notes I mentioned, and it doesn't tell you if the money they raise is just being used to pay off other debts that are coming due. They say they will put the total amount of debt in their regular SEC filings, like quarterly or annual reports, but not here. And finally, the numbers shown for the debt amounts are what is called at par. This means the face value, but it might not be the actual amount that shows up in their official financial statements prepared using generally accepted accounting principles. That is because the par value doesn't include things like discounts, premiums, or other fees. So, a little bit of a difference there, which is common but worth noting. The actual details of these issuances are in Exhibit 99.1, which is Schedule A. Unfortunately, we cannot see the content of Schedule A itself in this filing. Only that it exists, what we can gather is that the FHL Bank is in the business of borrowing money from the capital markets by issuing consolidated obligations. These are significant financial instruments that fund their operations, and, by extension, housing finance activities. Looking at the signatures, we see Edward V. Weller, who is the Chief Financial Officer, signing off on this report dated the 22nd of January 2026. This confirms that these are official disclosures regarding the bank's financial borrowing activities. So, what is the story here? The FHL Bank of Pittsburgh, like other FHL banks, is a major player in the financial markets, raising substantial funds through debt issuance. This filing highlights their ongoing activity in this area. The key takeaway is that these consolidated obligations are the lifeblood of these banks. but they also represent a significant financial responsibility that is shared across the entire FHLBank system. The emphasis on these obligations being backed solely by the banks themselves and not the government reinforces the need for prudent financial management and a clear understanding of the risks involved. When we look at this, we see a large, complex financial institution operating in a regulated environment. Their strength relies on their ability to consistently issue debt and manage that debt effectively. Any disruption in their ability to borrow or any sign of distress within the FHLBank system could have ripple effects on housing finance. The fact that they disclose this so transparently, even with some caveats about how to interpret the data, shows a commitment to regulatory compliance. Looking at the broader picture, the FHL banks play a vital role in providing liquidity to mortgage lenders, especially during times of economic stress. Their ability to tap into the capital markets efficiently is crucial for the stability of the housing market. This report, while seemingly technical, is a snapshot of that ongoing financial engine at work. What do I think overall? Well, the FHL Bank of Pittsburgh, as part of the larger FHL Bank system, is a fundamental pillar supporting housing finance in the US. Their reliance on consolidated obligations means that market confidence in the FHL banks as a collective is paramount. The risks are systemic within the system, and while not directly government-backed, they operate under heavy regulatory oversight. The strength of the FHL banks lies in their diversified funding sources and the backing of the 11 member banks. A notable opportunity for them is to continue to innovate in how they support affordable housing initiatives. A key risk, however, would be any significant downturn in the capital markets that could make it harder or more expensive for them to issue these essential obligations. It is a complex dance between managing their own financial health and supporting the broader housing economy. Alright, that is our breakdown of this FHL Bank of Pittsburgh's current report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.